relatively less important. When you talk about IFRS and its application, and especially when you are talking about the exam preparation, so mostly people are working in commercial organizations, and IFRS and ACCA is preparing their students for, getting them ready for the practical life, for the practical world. And they know that a very little percentage they go to such entities like government entities or budget organizations or NGOs where they would face government grants. Like 80% or 90% of the accountants, they would not see the standard, applying it in the real life, because most of you people are going to work in commercial organizations, and there is a very big chance that you would not face the scenario of government grants, because not all commercial organizations they get government grants. So this is one reason, that because this standard has less practical application, therefore they are not focusing it a lot on the exam, because what they are trying to do is that getting people ready for the market, and those standards, those areas which are more common in the real life, those scenarios are more common in the exam as well. So that was the reason I made that comment. So let's start at government grant. As the name, it's very self-explanatory. The government, sometimes it provides some form of grant to different entities, commercial entities, and the issue is that how to treat that grant. That grant could come in form of, probably, maybe they can straight away give some cash, they can give some asset, they can provide you with the land. For example, you say that I'm going to build up a hospital, or I want to build a school. The government will give you land as a grant. Government say, okay, we will provide the land and you will make the school. Or probably the government will give you, I'll give a very common example. I think I gave it before as well in some of our lectures, that let's suppose you have a school, and your school does not have a computer lab, and the government is focusing on providing IT education to the young ones. So the government will say that they will provide 20 computers to every school who will set up a lab. So you make a lab, you bring in furniture, and the government will provide you with computers as a grant. So how do you treat such grant? This is the issue. What is our accounting treatment of such a grant? So the standard is IS 20 objective and scope. The government grant, a form of government assistance and conditions related to entities operating activities. So the importance here is, like, the key word which you should, pick up is compliance, which means that the grant is never given unconditional. All the grants, they always have some conditions. So you must fulfill those conditions. If you do not if the entity does not fulfill those conditions, then they are not eligible for the grant. And if they have received the grant and then they are unable to fulfill, they probably have to return it back. So that grant, it becomes a liability, it becomes an obligation. And then compliance, this word, it also will help us in the accounting treatment. Let's move forward, and I will relate the accounting treatment with the word this compliance, because your accounting treatment will depend on this word compliance. So government assistance, a government action to generate an economic benefit for entities that meet qualifying criteria. So there should be some qualifying criteria. Like, grants are not given to everyone. For example, the government would say that we are only giving grant to those schools which have 300 or more children, or probably the schools which have been working for 5 years or more, or etc., whatever criteria they will set. So there is a certain criteria based on which they give grant, and when they give grant, they put some conditions which you have to comply. It is common for entities to receive government grants for various purposes. Grants may be called subsidies, premium, etc. So subsidies are given in agriculture. A lot of time we have seen, especially in agricultural countries, especially in third world countries, the countries which depend a lot on agriculture, and the government has to, uh, stimulate the agricultural produce, and they have to motivate people to keep on, be engaged in the agricultural activities. So government tries to make it more attractive. Like, what is the purpose of giving a subsidy or a grant? It is, the purpose is to attract people, to motivate people to keep on doing something. For example, in many countries we have seen that maybe the agricultural produce, it has higher cost of production than what the government wants to be sold in the market. So cost of production has gone up. The government comes forward and government starts giving subsidies in, in subsidy in the cost of electricity, subsidy in, seeds, or subsidies in fertilizers. Governments, they do give that, those subsidies, so that farmers, they remain, they have a reason to continue their activities. Otherwise they will stop agriculture. So different type of subsidies can be given, premiums can be given. They may also receive other types of assistance, which may be in many other forms. Assistance could be, consulting services. They are there. Training government provides to farmers. So because I started with the word farming or agriculture, so we will continue to bring in examples about that. So in agriculture, training they provide about some modern agriculture methods. Probably they provide some kind of consulting, design of their farmhouses, greenhouses. They provide, modern agricultural equipment at very subsidized prices, which farmers otherwise do not afford. The treatment of government grants is covered by IAS 20, accounting for government grants and disclosure of government assistance. IAS 20 does not cover the following situations. Accounting for government grants in financial statements reflecting the effects of changing prices. So changing prices, it is not covered. Government assistance given in form of tax breaks. So tax breaks are also not considered as government grant. Because in this case, it is not government is giving out something. It is just that government has decreased the tax rates. So tax breaks are not there, and the government acting as a part owner of the entity. So if the government is giving some grant to an entity in which the government itself is part owner, then that is not considered grant. For example, if government gives some, um, assistance to a government owned entity like railways, for example, so it should not be considered as grant. Under IAS 20 definition, it has to be another party. The government should not be part of the process. The government should not be the owner or part owner of that particular organization. Government has to be a third party to the organization. An entity should not recognize government grant until it has reasonable assurance that. So we talk about the measurement, recognition, that when entities should recognize, when should they recognize the grant. So it says that an entity should not recognize the grant until it has reasonable assurance that the entity will comply with the conditions attached to the grant and the entity will actually receive the grant. So because it is possible sometimes that grant is given in the beginning, or it is also possible that grant is given at the end. For example, if I talk about agriculture, in some cases the government gives subsidies in the beginning, like when you are buying seeds. So government provides you with seeds, for example, or they provide you with other agricultural inputs. But in some cases, the grant comes in the end. For example, the government says that you produce this much of wheat or whatever crop, and then we will buy it from you at certain price. So again, government is providing assistance, but it is possible that assistance is provided in the beginning or it may come in the end. So if the assistance is coming in the end, so you should not recognize it until you will actually receive the grant, or if you are meeting with the conditions. Because if these two conditions are not fulfilled, so it means that the grant will not flow in to the entity. Even if the grant has been received, this does not prove that the conditions attached to it have been or will be met. For example, like I told you that the government says that, okay, you prepare a computer lab and we will put in 40 computers in your computer lab. So that's a form of a government grant. And computers, they come in and you receive the computers on day one. But the condition was that you have to educate, you have to give free education to 1,000 children. Now keep this example in mind, that the government is giving you 40 computers. With this condition that by using these computers, you have to give free computer education to 1,000 students in that course. So the entity has received the grant. It has received the grant, but it is not, there is no assurance that they are going to fulfill it or not. So when they receive these computers, they cannot immediately recognize it. They cannot, because so far those conditions have not been met. It makes no difference in the treatment of the grant whether it is received in cash or given as a reduction in liability to the government. That is when the receipt is available. Any related contingencies should be recognized under IAS 37, provisions, contingent liabilities, and contingent assets once the grant has been recognized. This is very important, because if you have received the grant and there comes some, if you remember that uncertain liability IAS 37, the standard you have done, so you receive government grant, but then it is possible that if in future you will be unable to meet the conditions, you will have to return back the grant. So there will be a reversal, and that is going to be a liability. So it is going to be an uncertain liability, and it is possible that many times you have to create a provision, or maybe you have to make some disclosure note. If it is more than 50%, like probable, if it is probable, you create provision. If it is less than 50%, like if it is not probable, if it is possible, you make a disclosure note. But in any case, you sometimes have to create provisions or contingent liabilities against such government grants. In the case of a forgivable loan from government, it should be treated in the same way as a government grant when it is reasonably assured that the entity will meet the relevant terms of the for forgiveness. So forgivable loan is like government gives a loan, but with conditions that if you fulfill these conditions, that loan will be waived off, it will be forgiven, and you will not have to return. But if you do not fulfill the conditions, you must return back the loan. Accounting treatment. Now if we talk about, so there are two approaches which we will discuss. There are two methods which could be used to account for government grants, and the arguments for each are given in IS 20. Actually, previously there were two approaches. There are still two approaches, but one approach has been nullified so straight away that you should be only thinking about that there is only one approach, which is called income approach. I will show you two of them, both of them, but you do not have a choice to make one of them. You straight away will go with income approach. Okay. So the two options I will tell you, one is called capital approach and one is called the income approach. Although two options are given, and sometimes people think or students think that, okay, I've got two options, maybe with this, maybe with that. No, you are going to go with this straight away. But I'll just show you what the capital approach tells you. Capital approach, it says that credit the grant directly to shareholders' interest, which means that the grant goes to equity. So if you receive asset, for example, computers, so you say debit non-current assets, credit equity. So it does not go through the income statement. The grant is taken on capital approach. The grant is taken onto the balance sheet straight away. It does not go to your profit and loss. On balance sheet, on one side, you will debit the computer's equipment or maybe the cash if you have received. And on the credit side, you will make a credit to the equity. So the transaction remains in the balance sheet. It is not connected to the income statement. This is called capital approach, but we will reject it. Now, why it is a capital approach? Okay, let's just make one sentence, because the argument in favor of capital approaches, that the company did not earn it. Why should I take it to profit and loss? Why should I take it in income? The money which is coming in is not like sales revenue. It is not coming through the revenue. It is just a contribution. It's a contribution, and contribution should go into the balance sheet. This is the argument which I would consider a very weak argument for capital approach. The second is called income approach. And this is what you are going to follow. Income approach is that the grant is credited to the income statement over one or more periods. So you consider it as your income. And a very valid argument against the income approaches, if you remember the definition when I said that we are going to use the word compliance. Compliance. Because the grant is never given to you without compliance of certain conditions. There are always conditions associated with the compliance of the associated with the grant. You must fulfill some conditions, and to fulfill those conditions you will incur cost. Okay, like if the grant is given to you, they say, okay, we'll give you 40 computers, but you must provide education to 1000 students. So how are you going to provide this education? How? You will incur cost on that. You will hire some teachers, you will pay the rent for the computer lab, you will pay for the electricity bills, you will pay for the repair of the computers, you will hire probably a lab assistant, you may have to hire one or two teachers, so there will be cost associated to that. So you will incur the cost. So it means that the money which is coming to you in form of that computer, it did not come for free. You earned it because you did work for that. Okay, you worked hard to earn it. So